Hi everyone and welcome to the Everyman Investor. So in today's video, I'll be covering cash and savings plans which are a particular favorite of mine and form quite a significant portion of my retirement portfolio. Now, why is cash a good investment? So the normal thinking is that you should keep 6 to 12 months of normal expenses in your bank account, basically to buffer against unexpected expenses such as tax, medical bills, or any unfortunate events or any celebratory events you might have in your life. Now, cash on hand is also good for opportunistic investments. So, for example, if share prices suddenly crash, you can pick up shares at a good discount. Or, for example, if you are interested in buying treasuries and bonds, if the yields go up, you can also use the cash on hand to buy some. And you can also consider short-term fixed deposits to help maximize the investment of cash in your bank account, as fixed deposits typically pay higher rates. The only thing is that if you need the cash, then you withdraw it, the rates might be prorated or they might not actually pay you the interest that you actually were owed. So that would be a consideration. Now, savings plans. Okay, savings plans go by many names. There's the savings plans which your bank can provide for you. There are retirement plans, annuity plans, life insurance with cash value, and endowment plans. Okay, how it works is that I find you very useful because it's a force in savings. Once you commit to a plan, you either pay for it or you don't get it. So basically, it is a scheduled payment. So for example, say you have to pay a fixed amount every January for the next, say, 10 years because you bought this plan. You can budget for it and basically you're forced to save for it in order to ensure that you actually do get the returns for your plan. Now, if you start young, the compound interest is a very, very powerful investment tool and will help to increase your returns if you hold longer term. Usually above 30 years is where the returns start getting very interesting. Now, there are also tax considerations. So this one you have to discuss with your financial planner. Some countries actually do not tax insurance, annuity plans, retirement plans. So when you're old and you're getting out your retirement plans payments, you actually don't have to pay tax for them. And some countries have preferential tax rate for various plans or various retirement accounts. So these things are best discussed with financial advisor, but it's also good to keep in mind so that you know that these are things you need to look out for when discussing what plans will suit you best. Now, for those with family, especially those with young family, having concurrent life insurance coverage with your savings plans is actually very useful and also helps provide security for your family. So this is where life insurance with cash value is actually a very useful thing. So compared to normal life insurance plans, your life insurance with cash value has a higher premium, so you got to pay more every year. But the thing is, there's a surrender value. So if, for example, you survive, as most people should, then you can actually surrender your plan for the cash value, which will have accrued interest over the period of time you held the plan. Now, some of the things to consider. Number one, always go for a capital protected plan. Remember, investment rule number one is never to lose money. And look for plans with guaranteed returns. So nowadays, 3 to 4% annualized returns are common because treasury yields are somewhere in the region of 4.9 to 5% nowadays, and your provider will invest the money that you pay to them into treasuries or bonds or stocks, and they can get the extra returns to sort of profits for themselves and also to guarantee you your returns when your plan goes to maturity or when you surrender your plan. Now, there are also projected returns. So, for example, say if the investment that your service provider puts into does much better than expected, then you can get bonuses on top of your guaranteed returns, and that will lead to actually higher returns. Now, the risk of investment depends on the rate of returns. So when I first started, anything 3% or less usually will be low risk. Anything more than 5% usually involves the service provider investing into equities, which comes with its own risk. And anything in between usually is a mix of fixed income like treasuries and bonds, as well as equities. So based on my current plans, the plans that I have, the savings plans, the projected returns are sort of taking a tumble because of the current market conditions, but happily the guaranteed returns are still there. Now, there are various payment and maturity options. So there is a single premium upfront payment, which means to say that you pay a lump sum upfront, and then say in 10 to 20 years time, the plan matures and you can get back your capital plus whatever the interest you have gained. Now, there are also yearly payments, which is what most people will use because paying a large sum upfront is usually something that people like you and me who are sort of average, above average in terms of income, will not be able to afford. So my first plan I bought when I was 19 years old, which involves yearly payments of $1,500 a year, which I think is very reasonable as a sort of savings for anybody who has got a stable job and is hoping to have retirement savings. So for me, I have to pay every year for this particular plan until I decide to surrender it. And the maturity is actually when I'm 99 years old, which I'm not even thinking about, but I'm planning to take it out after 45 years. Now, the maturity option, so there's the fixed maturity date. So, for example, a 10-year plan or 20-year plan, or nowadays there are shorter plans like 3 to 5 years. There's flexible surrender date, which is the preferred option for me. So, basically, what happens is that if you have a 10-year plan, after 10 years, you can either get back your capital and your interest, or you can actually say that I don't want to pay anymore, but I'm returning back this capital and interest to you to continue accruing interest even after my payments have ended. So basically, you can just forget about it and just continue earning interest, and this is when compound interest actually starts to kick in. Now, to demonstrate the power of compound interest, now very conservatively, because like I said, 3% returns is actually low nowadays. You usually get 3.5 to 4% easily. So assume you bought a plan that has got a 10-year sort of duration, and your yearly payment is $2,000 a year. And so your total invested amount is $20,000 over the next 10 years. And at maturity, you get back $26,000 for the 10-year period that you have put in this investment at 3% annualized returns. Now, say you pick what I usually pick, which is a flexible sort of maturity or flexible surrender date. You decide to hold on for another 10 years. So you decide to put in the money for 20 years. So the $26,000 will go in for another 10 years. You make no payments whatsoever. And at the end of that 10 years, means to say 20 years after you first started investing at 3% annualized returns, you actually get about $35,000, which is a 3.74% annualized returns based on compound interest. Now, say you decide to hold for another 10 more years, which means to say you hold for a total of 30 years. Returns go up to about 4% annualized returns based on compound interest at very low to zero risk. Now, you started young, for example, you start at 20 years old and you say you have no use for the money, and you hold on for another, say, 10 years for a total of 40 years holding periods. Your annualized returns now goes up to about 5.4%, which is higher than the treasury yield that triggers market sell-offs. So that is where compound interest is actually a very, very powerful tool. Now, for the plan I bought at 19, if I hold it for 45 years, having compound interest working for me, I get back about 6% annualized returns based on a surrender at 45 years duration holding period. 6% for practically no risk. That is, to me, a very, very good investment. So to conclude, start young. It's best to start before 35 so that compound interest can work for you. If you can lock in, say, a 4% guaranteed return for 30 years, you can just imagine already at 3%, you get about 4.5% over 30 years. If you lock in at 4%, you get a lot more than that. So starting before 35 is the best option. And to be honest, younger people usually do not have the time, especially since you're establishing yourself in your careers, to really monitor the stock market, to read up on stocks, follow earnings report and stuff like that. Start small. So like I said, my first plan was $1,500 a year. As I sort of worked my way up the ladder and as my salary increased, I bought new plans along the way and basically built up a portfolio from there. Now, have an idea of what product you're looking for and then speak to the financial service provider. So the things to consider will be your budget, what returns you expect, the holding duration you want, as well as tax benefits that you can discuss with your financial provider. Now, always buy a product from a provider that is too big to fail, because in a situation whereby the provider actually fails, which usually does not happen, the government will step in to guarantee your returns, as you can see from the bank failures that have occurred over the past few months. So hopefully with all that I've shared with you, you'll be able to drive whatever financial service provider you approach towards the returns that you want, instead of having them drive you towards what product will earn them the highest commission. Believe me, there are tons of products on the market, so to get what you want, you really have to tell the financial service provider what exactly you are looking for, and there will be a product that is either that or something very near that. So that should hopefully power your portfolio and form a base for you to invest in more risky assets in the future. So thank you for watching, and I hope to see you in my next video where I introduce another different investment vehicle that I do use. So thank you.